Real estate can lower your taxes, but not the way most people think. Without the right timing and structure, depreciation doesn't do what you were promised. And if your depreciation strategy isn't intentionally designed, it won't offset your income when it matters most. In this video, I'm going to show you why depreciation fails most real estate investors, what's actually missing, and how the investors legally paying the least in taxes are thinking about this completely differently. If you've ever felt like you're playing the real estate tax game, but somehow still losing, then this video is for you. Hi, I'm Sherry Ayland, and I help high W-2 earners and real estate investors cut or completely eliminate their tax bill using my Zero Tax Blueprint. To find out if you're eligible, click the link in the description. If you watched my last video on depreciation and bonus depreciation, you now understand what depreciation is and why bonus depreciation is so powerful. If you missed that video, be sure to check that out. But here's the question most people ask. Okay, how do I actually get bonus depreciation on real estate? Well, that's where cost segregation comes in. Cost segregation is the tool that brings bonus depreciation to life for real estate investors. It's not a loophole, it's not aggressive, and it's not reserved for massive corporations. Cost segregation is simply a strategic tax planning tool that allows you to accelerate depreciation you were already entitled to take. So today, I'm going to break down what cost segregation really is, how it works, when it makes sense, and when it doesn't, so you can understand how it fits into the Zero Tax Blueprint. Cost segregation works because of how depreciation works. So let's quickly recap depreciation. Depreciation is an annual income tax deduction that allows you to recover the cost of property over the time you use it. The IRS recognizes that assets wear out, become obsolete, or lose value over time. That's why you can't simply deduct the full price of a building in 1 year. Instead, depreciation spreads that deduction out over a specific recovery period. For rental real estate, those recovery periods are long. Residential rental property, that's 27 and a half years. And for non-residential or commercial property, that's 39 years. And here's a critical concept that most people miss. Depreciation is based on the use of the property, not the type of building. That's why short-term rentals are treated differently than long-term rentals for depreciation purposes. Short-term rentals are considered commercial or non-residential, so they are depreciated over the longer 39 years. Now, here's the problem cost segregation solves. When you buy a building, the IRS does not actually require everything inside that building to be depreciated over the 27 and a half or 39 years. Certain components of the property qualify as 5-year, 7-year, or 15-year property. A cost segregation study identifies and reclassifies those components so they can be depreciated faster. This includes things like appliances, fixtures, flooring, cabinets, and certain electrical and plumbing components that will qualify for a 5 or 7-year property. Then you have land improvements like parking lots, fencing, landscaping, and outdoor lighting, and those usually fall into the 15-year category. Without cost segregation, all of those items are lumped together and depreciated slowly with the building. With cost segregation, those items are broken out and accelerated. Now, this isn't new or experimental. The foundation for cost segregation was established in 1997 in a major court case called Hospital Corporation of America versus the Commissioner. This case confirmed that certain building components could be treated as personal property or land improvements rather than structural. And that ruling is what made modern cost segregation possible. So what does this look like in real life? In many residential rental properties, roughly 20 to 30% of the purchase price can be reclassified into those shorter life assets. For hotels, medical buildings, or specialty properties, that percentage can be even higher. And here's where this ties directly back to bonus depreciation. Assets with a useful life of 20 years or less are eligible for bonus depreciation. Cost segregation identifies those assets, and bonus depreciation allows you to take a large portion of those deductions up front instead of spreading them out over decades. Now, as of January 20th, 2025, bonus depreciation on those items is 100%. Up until that time, for 2025, it was 40%. So here's an example of a short-term rental with the purchase price of $385,000 and land value of $45,000, making the depreciable value $340,000. Normally, that would be expensed over 39 years. Now, we're going to compare what the first year depreciation would be in the traditional way of doing it versus using cost segregation. You will notice that the traditional way of depreciating that rental over 39 years, in the first year, the deduction is $8,718. Now, compare that to the bonus depreciation with the cost segregation, where we've used a 25% figure for the under 20-year property that is depreciated at 100%. That comes out to $85,000. The remaining value that would be depreciated at 39 years is $255,000. When you take that number divided by 39 years, the standard deduction for depreciation is $6,538, and the bonus depreciation deduction is $85,000 for a total of $91,538. Same property, same total depreciation, but different timing. This is why cost segregation is often described as a timing strategy. It doesn't create new deductions. It doesn't eliminate tax forever. It just simply moves depreciation forward. That timing difference can dramatically improve cash flow and create powerful planning opportunities, especially when paired with the right tax status. But cost segregation does not make sense in every situation. It works best in years when you can actually use those losses. For example, when you qualify for the short-term rental rules, it enables non-passive treatment of rental losses. When you qualify as a real estate professional, this allows the deduction of real estate losses against all active income, particularly from real property income. Or when you have other passive income to offset, accelerated depreciation can reduce or eliminate tax on those passive gains. Or when you're intentionally planning around a high income year, maximizing the benefit of upfront deductions to lower taxable income significantly. If you cannot currently use passive losses, doing a cost segregation study may not provide much immediate benefit. Execution also matters. A proper cost segregation study should be performed by a qualified provider using an engineering-based approach with audit support. Rough estimates or free online calculations are not considered reliable by the IRS. And here's an important rule most people don't know. You do not attach that cost segregation report to your tax return. The report supports the numbers if the IRS ever asks questions, but attaching it can void the audit protection. A common question is whether cost segregation increases audit risk. A properly prepared cost segregation study does not increase your risk of audit. However, if the IRS reviews the depreciation, they will expect documentation that supports the classifications. And one last thing that surprises many people. If you place a property in service in a prior year and didn't do a cost segregation study, it may not be too late. In many cases, you can file a Form 3115, which is an application for change in accounting method to correct how depreciation was taken. This applies when you've been depreciating the property, but you didn't separate out the shorter life assets through a cost segregation study. Just remember, bonus depreciation eligibility is based on the original placed in service date, not the year you filed the form. And this is absolutely something you want to do with a tax advisor who understands the proper way to apply these rules. So here's the big takeaway. Cost segregation is how bonus depreciation actually shows up on real estate returns. It's not aggressive. It's not a shortcut. It's a strategic tool that has to be used intentionally and in the right situation. Now that we've talked about cost segregation and how it works, make sure you check out my video on the short-term rental loophole if you haven't already. Short-term rentals are one way investors are often able to use the losses generated by cost segregation and bonus depreciation, as we showed earlier in this video. But when investors want to scale that strategy across multiple properties and potentially offset larger amounts of active income, that's exactly where real estate professional status becomes incredibly powerful if you qualify. So be sure and check out my next video on real estate professional status.